Hey guys, it's Justin Amos, and in today's video, I just wanted to show you a little bit about credit spreads and sort of my strategy on how I use that strategy to make roughly 5% on my money within about 2 weeks with a 90% chance of success. So let's go ahead and jump right in, and I'm going to show you exactly what I'm doing with these credit spreads. So the first thing that I might do is kind of look at the charts, and I'm going to pick Walmart because I've used it quite a bit. We're going to see how it's going, and you notice it's kind of way up here. The stochastics are going to kind of tell me the same thing. So it'll probably come back down when I'm not sure. So I could really go either way with this one. I could look and say, I don't think it's going to go to 150, or I could kind of go back down since it is on an upward trend. Say, I don't think it's going to go down to 135. I mean, 135 is down here. So I'm going to go ahead and sell the upward. I'm going to assume that it's going to go up, and I'm going to go and place my trade somewhere down here. So let's see what we actually need to do. I don't need to guess what amount. I need to go ahead and let the numbers do that for me because this is all a numbers game. So since I'm wanting to sell, I want time to be on my side. So I'm going to sell something short term. So I'd probably pick this one here, 15 days. So that's about 2 weeks. An August 20th expiration. And since I think it's going to go up, I'm going to stay on the side of being down. First thing I'm going to do, rather than being in a vertical spread, I'm just going to go ahead and look at the singles and see what all I'm looking at here. And the first thing I'm going to do is look at probability in the money and try to find something around 10% somewhere here. Now, it may be better for me to go ahead and pick this one just because you see a huge amount of open interest on this one. So that means it'll be more liquid. It's actually got a little bit better than 10%. So if you've watched some of my videos before, you want the credit spread to expire worthless. So if there's basically a 9% chance that it will end up in the money, then that means there's a 91% chance that it won't. And that's what you want. So in this case, if we bought this, we're looking at a 91% chance or so of success. So let's look at this one here, a 135, and maybe down to a 130. Okay, 135, 130 spread. That's what we're going to do. So we're going to go to a vertical spread, and we're going to do the 135 here. We're going to sell a 135, and we're going to go down to 130. So by doing this, what I'm doing, I'm selling and then I'm buying one that's lower. I'm capping my gains and I'm minimizing my losses. And I'll show you what that means here in a minute. But the thing that you need to see, open interest, that you've got that, you need to see the probability of success that you look for under the single rather than the vertical. The deltas on it's going to also be there to look good. And you're going to go in here and trade this. Make sure whatever you do, they're going to trade together if you do it this way so you don't mess up. However many contracts you want. So let's just say we're going to get 5 contracts of Walmart, both of the same expiration. You're selling one at 135, you're buying at 130. And you've got an 18-cent limit here, and that's going to be a credit to your account. So you're going to get that up front. So let's see, limit day, all this is fine for right now. We're going to confirm. So what we're looking at here is a max profit of 90 minus, because you're having to pay your fees. Your credit is going to be $83.50. Now your max loss is going to be $2,410. And I hope most of you are looking at that like, why would I risk that much just to make 90 bucks? Well, the reason why is you've done your homework and you realize there's a 90% chance of success. This amount here is how much you could lose if everything went the absolute worst case scenario, which in later videos, I'll show you how to remedy that so that if it does start going against you, you don't lose this much money. But you do have to have that much in your account just in case that does happen. chances are you're more or less going to make this every time. Um, so let's go ahead and I'll show you the percentages on that, like how this is actually going to work. So you've got a chance of making $83.50 on your money. So you'll take that and divide that by $2,410. And I said 5%, you can adjust it a little bit. But basically what you're looking at on this is a 3.5% return on your money within a week. Now you can go back in and you can adjust the numbers to make it closer to 5%. I typically want to go in here and do anywhere between 4.5 to 7% on my money. And it just depends on my risk tolerance, how happy I am with it. So I might want to make $100 on this to be happy, or I might want to get it to 5%, whatever the goal is. But you're kind of looking at that, and 3.5%. If you're happy with 3.5% on your money every 2 weeks, then that's not too bad. But typically I want to look anywhere maybe 4.5 to 7%. And I'm not guaranteeing this works all the time. Obviously, there's always risk, and it went through and showed you your probability of ending up in the money. So if everything kind of goes the way it has been going, you're looking at about a 91% chance of success, which is pretty good. I mean, if you could win the lottery 91% of the time, or have 91% chance of success, how many tickets would you buy? So that's just kind of a way to limit your loss. You cap your gains, but you limit your loss with a high probability of success in a short period of time. And that's also key, that you can turn it over and over and over. So that's basically how I do my credit spreads. And I do that, I get the money up front. If I were to do this right now, it would put $88.50 in my account and hold the 2,405 on reserve until I got out of this trade. And the good thing about it is I don't have to actually sit in there the whole time. So here are some other credit spreads that I have going. And if you look at SPX, I've been in this trade for like maybe 2 or 3 days, and it's already at 52% here. So what that means is that the most amount of money I could gain, I've already got 52% of that. So once it gets to like 80, if I reach 80 in 5 days, I've only got 20% left to gain in 10 days. So that's, you kind of think about it, I could take that money, go ahead and cash out and get into another trade, rather than having to wait all that time with the opportunity it could go down. So, I'm 250 right now. So I'm looking at making close to $500 if I were to wait for this. But if it gets to 400, 425, 450, I'm hanging around for that little extra when I could go ahead and start making more gains on another trade. But that's just your risk tolerance. That's however you want to handle that. But it's just something to consider. It's a good strategy that I use. And again, when you're trading this, go to your paper trading account. That's what I've got here. Simulating trading using Thinkorswim platform with TD Ameritrade. Don't risk your real money. Practice, learn how to do it, and then you can go in and invest your money. So I hope this video was helpful, and thank you for watching. I will see you in the next video.